All right. Good morning, everybody. Day 2. The Spot Gamma Founders Note came out on the AM edition right before I started. So I didn't get a chance to read it, but I'm downloading it now. I'll get it shared out. You guys will get a chance to see it before I do. In the PM edition, they really laid out an argument for the need for clarity and or a macro event, a maybe a news event, or options expiration. The good thing is with that, we know when OPEX is, simple enough, and we can all just keep track of the news, realizing that if we see a market rallying without either of those two, we're not on OPEX and we're not getting any economic news attached to the rally, then it's probably just a minor dead cat bounce. Markets are up a little bit this morning, still within the shadow of yesterday's fake pump. There's been a lot of jaded remarks about where that rumor started. So far, it's been tracked back to a bank. You can kind of just use your imagine whether it was, JP Morgan, Citigroup, Goldman Sachs, one of those apparently started that false rumor to get a pump and then sold puts into the pump from the long puts that they had owned. So they sold puts to close and then bought more puts. The buying more puts part of that discussion implies that we still have room to the downside. All of that was in the PM edition of the Founders Note. So if you want to read more about that, just check out the Spot Gamma PM edition Founders Note. We do have more Fed speakers chipping their teeth today. We expect more talk about the tariffs. We've got some auctions, and we have a little bit of news coming out of Europe. European Central Bank is going to also have somebody out there chipping teeth. Yeah, the bonds were really freaking me out yesterday, and I know I'm not the only one. It's a really dangerous environment, and I can't stress it enough. That we really are missing a lot of information, and markets are not behaving the way that they typically should behave. And while newer traders may hear that and think, okay, well, so what can we do? When we don't have the kind of answers that when we don't see the markets behaving in a way that makes sense, we don't try to force some theory or outcome from it. What we do with it is get the heck out of the way, right? And we wait for more information. We wait to find some clarity or some understanding on what is happening. There's just times where we don't have answers. And I know that's not what anybody wants to hear, but that's just the way it goes sometimes, and some of the best decisions I've ever made in my trading life was to just get the heck out of the way and wait. So, do that. Um, I appreciated the leg down personally because I had already started allocating last week longs for a longer term portfolio. And I said, well, if we leg down again, I will do another 25% because I'm running, 25 and then 25 and then 25. And so this new leg down was just a nice little gift. Looking at the overnight volume, we're sitting at 200,000. That's a bit light compared to 491 yesterday and 500,000 on Friday, but it's still an elevated number. The typical overnight number is somewhere around 60 to 70,000. So, getting 200,000 is still elevated. One of the reasons that we moved so radically yesterday in such a short period of time is because of a lack of liquidity. Now, I know I just said this is a lot of volume, and then you hear me say we moved a long ways because we don't have a lot of liquidity. In the futures, in this product right here, we've got a lot of volume. But if you go look at, say, SPY, and you look at the options volume, it's horrible. The bid-ask spread is really wide. The SPX options bid-ask spread really wide. And that lack of liquidity is one of the major reasons we moved so far. It's why we say that in a thin market, markets can make really big moves, right? Newer traders really struggle with that concept. But if you don't have a lot of market participants or everybody's fighting to be on one side of the market, there's just not enough liquidity and price can move really fast in that situation. It's not done yet. By any stretch of the imagination, it's not done yet. We've got a long way to go, and a lot of that distance that we need to travel is coming to an understanding. We just don't have clarity, and we don't have a forward outlook that stays put for more than 24 hours, right? We get information, and then almost immediately they start to either walk it back or adjust it or make concessions or discuss the idea of making concessions, and then we lose clarity again. Another leg lower really feels appropriate, and according to Spot Gamma, it's what the money is focused on, is another leg lower, buying a bunch of puts into that push yesterday is what they were lining up for as well. We are coming up into the 3-day moving average. I know it's a very small moving average, but it goes towards a surge play. The typical surge would be to cut through the 3 and then cut through the 10 and then have the 3 cut through the 10. That's generally how it goes, right? So it's a step-by-step process. Break through that line, break through that line, and then this line comes up and crosses through that line. That's a surge. In that step-by-step process, one of the first things you have to do is get through that line, right? So when we zoom in, we can see that line right there. It's lined up on one of the Spot Gamma lines, 52.45. We got to get through it. We hit it yesterday. We weren't able to get through it. We can see we wicked through it in that really explosive move. And if we just get rid of all this stuff for a moment, my concern at the moment is much like a liquidity gap. We get those on CPI day, PPI, those kind of situations. We can get back up into this zone, and any unfinished business or trader's remorse at that spot could be the destination that we've been looking for, and then we sell right back off again. So you can see we're there. We're dealing with just the wicks. There's an old market phrase or adage that the bodies of the candle is where trades are at, and the wicks of candles are where stops were at. Now, you take that with a grain of salt. but we are into the wicks now. And if this is going to reject, it's going to do it within this box, right? We won't, if this is going to reject, we won't make it through the other side of this box. We won't get to the top of yesterday. We won't get a breakout of yesterday. We'll end up coming back in again before that happens. If it's a liquidity gap, like I think it is. If it's not, then we'll focus on just a typical 111, which is measuring all of yesterday's RTH and laying out a 111 and a 1236, which gives us 5332 cog line, because that's just how it works. All right, we've already made it through the lower ADR. We can get to the upper edge. We would still be inside of yesterday's price action. And from there, we could measure this entire range and leg up another one beyond that. $53.30-ish. I kind of drew that a little sloppy. I would bet it lines up pretty close to 53.32 cog line. Imagine that. That's where we start stacking the ands. 53.32 is a cog line. It's also the 1236 of yesterday. It's also the measured move of an ADR, one deviation higher. Sorry, it's and. And we do have a way of using these ADRs. Generally, we say if we get to one side early enough in the day, we can go to the other side by the end of the day. The thing is, it doesn't owe us a move to the other side. That's just generally what happens, right? Because the way markets move, they don't just generally move in a straight line. If they're moving higher, they're still going to pull back along the way. If they're moving lower, they're still going to pull back along the way. It's just the idea of the way the markets are supposed to move. So generally, when we hit the upper edge, we say, well, we did it pretty early in the day. We can probably hit the other one by the end of the day. And it wouldn't mean we're bearish. It would just mean we're making the other side of that wave. But we don't have to do that. We can just continue to go higher, push through the yellow line, and even continue higher beyond that. We have a narrower channel this morning than we did yesterday. A narrow channel implies that if we break out, we could run, that it could grow legs and just continue to go. If you look at this channel and look at Friday's channel, they're very similar in size. The narrower the channel, the more likely it is that a breakout sticks and we actually get to keep it and that we continue to break out. A wider channel implies that if we do try to break out, that it fails and we come back in again. One thing to keep in mind is these channels don't make price do anything. We don't break out just because the channel is narrow. And we don't not break out just because the channel is wide. These are just more of a signpost or a guide on what to expect if we do get a breakout today. And this isn't as narrow of a channel as it could be. It could be so narrow that you don't even see the yellow lines. You just see a purple line there. That's how narrow it could be. Today's floor pivot is lower than yesterday's. That's bearish, but we opened above it and that's bullish. We haven't hit it today, and that's implying that we're going to go down to hit it. Now, we don't have to. You can see how we didn't hit this one on Friday. Other than that crazy wild spike, we didn't hit one yesterday. We didn't hit it on Thursday. Markets are supposed to hit their pivot 80% of the time. So right now, statistically, we're not hitting that average. This is a missed daily pivot. It won't count today. It'll count tomorrow. And if we don't hit it today, and we actually do get it for tomorrow, then it is the start of a move back up. And we're not talking about a recovery here. This is not a discussion on everything's fine and we're going to recover and go back up, and none of that kind of talk. Only a discussion on the idea that if it's a push to the upside, that we could get back to the 10, maybe to the 20, because it's just like a dead cat bounce. And then we'll roll over and head lower from there, or we'll digest that dead cat bounce and make a decision at that point. R1 is at 53.27. So if we do continue this drive to the upside, we have to first get outside of yesterday's range, then get through the weekly floor pivot, and then we get to the R1. The concern about R1 is that there's a trade strategy that sees price get to an R1, and that triggers the short, and we go for an S2. That would be 46.24 by the end of the day. Now, generally, if we were looking to play that approach, we would have gotten to R1 much earlier in the day. I know if you're new, you're thinking, what is he talking about? The day just started. You probably just crawled your butt out of bed. It started last night at 6 o'clock, however, and since it's past 6 a.m. this morning, the day is half done. Sleepyhead, you missed half of it. If we were going to go from an R1 to an S2, we should have already been to the R1 by now, so that we don't have to rush to get to the S2 by the end of the day. It's not to say that we can't do it at this point, but I would say if that was the plan, we should have gotten there a lot sooner. So the other strategy that goes with these is that we just get to the R1 and hover around it or reject off of it, maybe fade back towards the floor pivot, or we get above the R1 and we keep it for the day. We have a classic D-shape profile at this point. We are outside of the 70%, the value area, pushing to the upside. You can see how we were holding that value area until now. We're finally getting that push. We didn't leave much of a footprint behind, at least on this time frame, in that really big wick that we had yesterday. And we're moving through this distribution zone right now. This is going to be the trouble with trying to get through 5,300, is trying to get through all of that. $56.31 is the new point of control on the 10-day, 30-minute. We've got a shallow area that we could work through. If we can get to 53, it gets shallow above that into 54. So getting that 100-point range is going to be a lot easier. The trouble is just getting through that big high volume node to get to 53. With the point of control where it is now, we're likely not going to see it move anytime soon unless we build out one of these other structures. We could build out this one since we're already there. Well, we were before we had this little breakout this morning. that would be around the 5,200 area. But now that we've started the push, we'd either have to build out this one on the value area line or up here around 55. And I don't think this bounce is going to 55. That seems like a bit much. Value area high and low have been known to be resistive to price. So the concern is we're going to get into that 52.75 or 5,300 area, and we're going to reject off of it like we did in that big bar yesterday. Okay, this point of control is done at 51.75 from Friday. We hit that yesterday, but we built a new VPOC yesterday as well. So we'll just steal that line and bring it down here. $50.86. So if we fade to the downside this morning, we've got $50.86 for the VPOC. Otherwise, a continued move to the upside. We do have these higher level ones. They just seem out of reach at this point. We're still inside the range for the week, and that drive to the upside didn't even get us outside the box. As wild as that is. And you know, the other day, I had pointed out a lot of examples where we had these turnarounds off the low, right? We've got a lot of really great examples of these great turnarounds where we have a low of 2 or 3 days in a row of just really nasty price action. And then we gap down on a Monday, we get much lower, and then we have a strong recovery on that same Monday, which follows through into Tuesday. I gotta tell you guys, that's not what we got yesterday. So let's go back here for a minute. If we had gapped down like we did, and we had that big wick like we did, and we rallied back up without leaving that big wick on top, we'd be in a much different situation. We have to worry about the midpoint of this bar and whether we closed above the mid or not. And then we have to worry about the 75th percentile, the last 25% of that bar. When we take a candle and break it down into 4 parts, we can see that we closed higher than the midpoint. That's absolutely a needed thing right there. But we should have closed above the 75%. Now I have 78 showing, but it's close enough. We didn't close above that 75. And so what we ended up with is this really big wick here. And this just becomes a big resistance zone. That entire wick is the resistance zone. It's a massive level that we have to fight to get through now. So we can, you know, it's not to say that we're doomed because price can do whatever it wants. It can certainly get through this wick, but it just screws up the whole play. It's not supposed to come through like this. It's supposed to be a very sharp V-shaped recovery. And one of the reasons that we look for this really deep wick with the flip is because of what it is designed to be. It's like a bear trap, and trapping those bears and then squeezing them on the way up so that the buying is driving this up and those bears have to buy to close, and they add to the buying, which drives it up. And then we get this very sharp, very swift drive back in the other direction, which is what causes that V that we all like to play. But this wick screwed all that up. And now we're going to spend a lot of the energy that we would have used on that V just trying to get out of this wick. So if there's any juice left after that, then sure, we could probably go a little bit higher. I wouldn't expect a lot more higher out of that. Not without news or some kind of economic event or OPEX. If you're wondering when OPEX is, it's the third Friday of the month, always. You can always just look at the third Friday of the month. It's the 18th for April. We're still more than 6.5% below the 10-week, so we're looking to move back towards the 10-week. That's healthy. It's not bullish to be moving back towards the 10. It's just more of reflexive action than anything else, right? Same thing with the 10-day. We're still close to 3.5% to the downside, and we're moving back towards the 10-day. But we've got a long way to go. We need to get a lot closer to that 10 before we even consider the idea that this market is starting to heal from that very big move that we had. That big move damaged the market. It broke things, and we need to heal from it. We need a correction, and that correction can come through price action or from time. One or the other. 53.16 is the upper edge of the expected move, which I wouldn't put a lot of weight into that right now. We've been breaking the edges of the expected move frequently. And in this environment, they hold no sway. We could easily break that and close outside of it on the week. I think it's easiest just to look at what's down today. The VIX. The VIX was up 87% in the last 5 days. Actually, 100% if we put this 14% on there. It was up 100%. It's down 14.5, which leaves us at 86 over a 5-day period. Golly gee, that sounds like a lot. Otherwise, just about everything is up at least 0.5%. Gold and gold miners lead to the upside with banks right behind that. Speaking of banks, we're getting ready to kick off a whole new earnings season. And in the idea of going lower, the next leg down. Good Friday. Hey, that's a good point. I had mentioned OPEX is the third Friday of the month, and it always is, unless we have a holiday, which we do. Thank you for that. It's on the 17th because Good Friday markets don't, they're not going to be open, so there won't be an OPEX to have there. So there you go. Always check holidays. Gold miners finance is up as well. Banks are going to kick off the earnings season, and they set the tone. So if they come out and they're very negative, which we've been hearing from Jamie Dimon and some of the other wannabe celebrity bank CEOs, wannabe or not, they hold sway when they talk. And if they start giving a forward outlook that's really negative and they start, throwing around a lot of caution and fear, they will set the tone for the entire earnings session, right? For the whole quarter. And that very well could be our next leg lower. You know, a lot of analysts are slow to the game when it comes to repricing, and well, it could get ugly. For today, though, finance is right behind gold miners, then uranium, pot stocks. We don't want an S&P NASDAQ rally based on pot stocks. Then we've got semiconductors, small caps, consumer discretionary, and technology. When we look at the sectors that are up on the day, there's three that I really want to see if I'm looking for a rally day: consumer discretionary, technology, and finance. Now, all three of those are really vague, because when I say finance, I mean, that could be anything: trading desks, insurance companies, banks. There's just so much that can go into finance. And the same with technology. How generic is that? You know, it could be cloud computing, chips, semiconductors, software as a service, quantum systems. Just saying tech is just really vague. So still, those three sectors are what we really want to see if we're looking for a strong rally day in the S&P and the NASDAQ, which can bleed out into other sectors like cloud computing and chips and semiconductors. So this is a good start. We have those up this morning, but we also have everything else. Now, on the one hand, with that, you got the rising tide scenario. So you get the Mag 7 moving, you get the right sectors moving, and you get everything else coming up with it. The problem is everything was so beat down that getting this rally today across the board with such a high correlation, it just feels more like a dead cat bounce than anything else, a reflexive bounce rather than any strong rally at this point. And we still don't have the rotation that we've been looking for, right? And this is certainly, it's not it. So, you know, get it while the getting's good, but I wouldn't expect any of this to be the end of our troubles. If we're looking at things that haven't moved at least 0.5% this morning that may have a little room left to move, crude is near 0.5%, but hasn't gone past that yet, and airlines are only up about 1%. Most of these are probably going to make really nice shorts when they roll over and we go to make the next leg down. %83 of the NASDAQ 100 is up at least 0.5% this morning. That's a high correlation. You can run your alpha protocols at around 95 to 97%, and we're only at 83, so we're not quite there, but it's a step in the right direction. And we have the right sectors, so we could certainly get the drive this morning. And 87% of the S&P 100 is up at least 0.5% this morning. And again, 87 is good. It's really good. But we would want 95 or 97 to run the protocols. So keep your eye on the clock and the news. Watch for headlines to get the play. The 3-year, it's really up front. You could just watch the IRX if you want to just keep track of the front end. I don't think most of these Fed speakers are going to give us anything useful. White House headlines may be more impactful than any of this, and we can't anticipate if and when we're going to get those. So I got for you guys, be careful, be safe. I'll see y'all tomorrow.